Okay, so this is where we were at the end of our last class. We were learning how to measure GDP by the income approach. Now, let me spend just a couple of minutes recapping this material, okay? Now remember, the critical concept here is the circular flow of income, correct? So let's go back to the circular flow of income. This diagram, correct? So what is this diagram about again? Remember that there are 4 shoppers in this economy. And who are the 4 shoppers? 3 of those 4 shoppers live here at home. They are US households, US government, and US firms who buy machinery. Remember, machinery is the only purchase by firms that we consider here because we're only interested in final goods and services, right? And machinery happens to be a final good, even though it's used to make other goods. It's a final good because it isn't dissolved into the goods that it makes, right? So we have these 3 shoppers at home, and who is the 4th shopper? The rest of the world, correct? And they each send money into the cash registers of our firms, right? Now, if you add up all this money that's flowing from these 4 shoppers into the cash registers of our firms, if we add these sums up, wouldn't we arrive at the value of goods and services produced by our firms? Wouldn't we? Because if somebody shops for something from our firms have to make that item, don't they? Right? So if these 4 shoppers have spent, let's say, $15 trillion on goods made here at home, this must mean that our firms have produced $15 trillion worth of goods and services, meaning GDP, right? So that is the expenditure approach to calculating GDP. You figure out GDP by asking the 4 shoppers what they spent, right? That is the expenditure approach to calculating GDP. So we're basically adding up these 4 flows that you see here. We add up the 4 flows just before the money is entering the cash registers of our firms, right? And so by the expenditure approach, GDP is equal to, GDP is signified by the letter Y, right? Is equal to the sum of the 4 spendings by these 4 shoppers, right? Now, before I proceed to the income approach, I'd like to do one little thing that I omitted to do in class last time, right? It's not something in the PowerPoint lecture notes, but there are questions in your MyConLab homework that deal with this. So let me quickly do a little something that I missed in class last time, okay? And in order to do that, I'm going to go to my drawing board. And let me write the equation for GDP by the expenditure approach. What is it? Y is equal to C plus I plus G plus X minus M. What is X minus M called, by the way? Somebody, what is the name for that whole thing? Yes. Now, I'm glad to see that some students are keeping up with this stuff. By the way, there is a formula for success in college. You know what that is? For every hour in class, you're supposed to spend 3 hours outside class studying this stuff. How many of you do that? If you have a 4-course load, which is 12 hours a week in class, you're supposed to spend 36 hours a week, or at least 24 outside class studying that stuff. All right? Now, net exports. Now let me do something here. Let me subtract C from both sides of this equation. So we have Y minus C then, and that is going to be equal to I plus G plus X minus M, correct? Everyone's fine with that little bit of algebra? Now what is Y minus C? Remember, Y is GDP, but it is also the income of households, and this we know from the circular flow of income. Is that correct? Because we know that every penny that comes into the cash registers of firms, makes its way back into the pockets of households as factor payments, right? So Y is income. Now, if I take your income and I subtract from it your consumption spending, what am I left with? Well, if you take your paycheck and you subtract from it everything that you spend on yourself to live, what are you left with? What's the word for it? Saving, is that correct? Right? Now, let me say that this income here is gross income. This is income before taxes. Okay, so if this is income before taxes, remember you still have to pay your taxes. So from your gross income, if you subtract consumption spending, what are you left with? You are left with savings plus the taxes that you will pay. Am I making sense here? Right? So Y minus C, Y meaning gross income, pre-tax income, minus household consumption spending would be household saving plus the taxes that households pay the government. Is that making sense to you? Now that's true for households as a whole. It's true for you personally, isn't it? Right? Now, S plus T is equal to I plus G plus X minus M. Right? And what is S? S is household saving, and T is the taxes that households pay. Right? Now this here is an equation that you will need to use to answer at least some of the questions in your MyConLab homework from Chapter 5. Okay, so keep that in mind. Back to my PowerPoint lecture notes now. So what have I said here quickly to quickly repeat here? So gauge reading B is going to be a bit smaller than gauge reading A because of those two leaks. So we adjust for those two leaks, and these are the two leaks. We adjust for them, and these two leaks, once they're added to your gauge reading at B, you should then theoretically get the same answer as at gauge reading A, correct? However, we need to take into account the fact that there might be a small statistical discrepancy between those two methods, right? So statistical discrepancy is simply an accounting device that is added on to your gauge reading B adjusted upward, right, in order to ensure that you get the same answer as you got by the expenditure method. Yes? Right, so this is what we have here. This last sentence on this slide, I hope you comprehend it now. So what is this item here? What is net domestic product at market prices? What is this again? This is the sum of wages plus rent plus interest plus profit plus net indirect taxes. So this is taking care of that first leak, right? And then we add to this the second leak. And this gives us GDP, theoretically, right? But then there is the issue of statistical discrepancy. And statistical discrepancy, as it says here, is the discrepancy between the expenditure approach and the income approaches to calculating GDP, right? And so this is an accounting device that has to be added on to the expenditure approach formula to get GDP. So this is simply to ensure that you get the same answer by both methods. Is this understood by all of us? Yes? So we have these two approaches to calculating GDP, and it all boils down really to the circular flow of income idea. And what is that circular flow of income idea? That all the money spent by the false shoppers on goods made here at home, the money that, in other words, enters the cash registers of our firms, all that money must make its way back into the pockets of households. Well, not strictly speaking, not all of it, because we have those 2 leaks, correct? But once you account for those 2 leaks, then we ought to get the same answer from the income approach as we got from the expenditure approach, right? So this is how GDP is typically calculated by governments. There are these 2 approaches that can be used, okay? And this is what GDP in 2011 looked like. So once again, we have 14,997, which is $1 billion, of course. Remember, that was the same figure we got by the expenditure approach, if you recall. Now notice here that statistical discrepancy is a negative amount. It's a negative amount because if you added up, if you took gauge reading B, in other words, and you adjusted it upward, you got a figure that is slightly bigger than the 14,997. So the income approach gave you a slightly bigger answer than the expenditure approach. And so the income approach had to be brought down a little bit to make sure the 2 answers are the same. So statistical discrepancy in this case is a negative amount. This is an accounting device, so we had to subtract $73 billion from our gauge reading B adjusted upward for the 2 leaks. We had to remove $73 billion to ensure that the income approach gave us the same answer as the expenditure approach. Okay? Now, if you look at the other components here, what's the big item here? Well, the big item, of course, is wages. Labor is the commonest resource out there owned by households. We all own labor. Not all of us own capital. Not all of us own land, and certainly not all of us are entrepreneurs. Right? So labor is the biggest ticket item there, correct? It's more than half, you can see. 8273 divided by 14,997 is more than 50%, clearly. Right? And then you have the net operating surplus, which is interest, rent, and profit. That amounts to about $4,000 billion, $4 trillion. Right? Now, I would tend to think, well, not so much, not this. There are plenty of small businesses out there earning a profit. So you look at, business America, or corporate America, all the businesses out there aren't mega corporations. There are these mom and pop stores as well, right? So profit is, it's dispersed among the rich and the poor in some way, perhaps unequally, but you would see even fairly, middle income people or lower income people even making profits. The guy who runs a taco stand would make a profit as well, correct? But when you think about interest and rent, this seems to go mainly to the rich, because they are the ones who would own such things as capital and land, right? And then when you look at wage income, this, of course, goes to everyone, rich and poor, but it is quite unequally distributed in the US. You see, a lot of that goes to super rich, highly skilled people, brain surgeons and computer scientists who work at Microsoft and Apple and so on, correct? So in order to get a bite of that action, it's important for you guys to spend 2 hours outside of class for every hour in class. You see what I'm saying? And now we come to another measure of the product of the nation. And this is called gross national product. You see, the difference between the 2 phrases GDP and GNP is one has the D, one has the N. So we have national as opposed to domestic. And what's the difference between these 2 terms? The word domestic refers to within the US. Domestic refers to within the US, production that's being carried out within the boundaries of the US. National, on the other hand, is not concerned about where the production takes place. You follow me? So GNP would include stuff produced by the use of American resources anywhere in the world. As long as the final goods and services are being produced using American resources, it's part of GNP. It doesn't matter now where the production takes place. Am I making sense? So what is GNP then? It says here, GNP is the market value of all the final goods and services produced anywhere in the world in a given time period, usually 1 year, that's the typical time period, by the factors of production supplied by residents of the country. In other words, anything made anywhere in the world using either US land, labor, capital, entrepreneurship is part of US GNP. Correct? Now, how do you work out the contribution of an American resource to production abroad? How do you work this out? Let us say that we have a US engineer in Germany. This guy is, let's say he's an automotive engineer and is working for BMW in Germany. Right? And let's say this guy's salary converted into American money is $150,000. Correct? Now he is an American resource. Is that correct? He is an American resource. So his production by him anywhere in the world is part of US GNP. Correct? How do we figure out just how much he made in Germany? How do we figure out his contribution to German GDP, in other words? Because whatever that contribution is part of our GNP, because he is an American resource. Am I understood here? Right? GNP is the value of all final goods and services produced using American resources anywhere in the world. This guy is an American resource. He's American labor. Right? Now, how do we figure out what he produced in Germany? The value of what he produced in Germany, so as to count it as part of our GNP. Any ideas? All we know is his salary. Can we use that salary to figure out his contribution to production of final goods and services in Germany? Yes, right? What logic would we employ? Precisely. You see, what she just said is that you can basically use the logic that any resource is paid the value of its contribution to production. Now, this engineer is being paid $150,000 because he produced $150,000 worth of goods in Germany. No resource is overpaid by this logic. Everyone's paid what they're worth. Is that correct? Now, you may think that, well, you may have a cousin somewhere who just got lucky and made a lot of money. Now, that's possible, but that is rare, right? As they say, you're more likely to be struck by lightning than win that 400 million jackpot that's out there right now. Do you know? So people who strike it lucky, well, they do exist, but they are rare. So we can employ the logic that people are generally paid what they're worth. Correct? And what they're worth, what do I mean by that? Their contribution to production. So we can basically say that this $150,000 is the contribution of that American engineer to production in Germany. So this then is part of US GNP. Right? Now let us look at the reverse of this. Let's say that we have a Japanese manager of a Toyota plant in Alabama. So this is the Japanese manager. He's been sent by corporate offices in Japan to manage the Toyota plant here in the States. Okay? And let's say that his salary is $500,000. I'm giving you these large figures so as to, in a sense, inspire you a little. Okay. Now, $500,000 is his salary. Now, how do we count this? He's being paid $500,000 because, presumably, that is his contribution to production here in the US. Is that correct? Now, this 500,000 would be part of US GDP because it is production taking place within the boundaries of the states, right? But the question is that 500,000 part of US GNP? Is it part of US GNP? In other words, was this production carried out using American resources? No, because he's a Japanese gentleman. He's a Japanese resource. Correct? So that 500,000 is not part of US GNP. It is part of US GDP, but not part of US GNP. Am I making sense to you? So, if we have the GDP figure, can we get GNP from it, is the question. Okay? And let me now go to my drawing board to show you how that might work. Okay, so we have GDP. And GDP is everything made, all final goods and services produced in the States. Now, some of this production, that $500,000, for instance, earned by the Japanese manager here in the States, now that isn't part of GNP, is it? Now, that was part of GDP, but it was produced by a Japanese resource, so we need to remove it. We need to remove that 500,000. Is that correct? Because that is money earned by the Japanese manager. Am I making sense? In order to get GNP, that is. I'm trying to get GNP from GDP. I'm trying to get GNP from GDP. So that 500,000 has to be removed from GDP to arrive at what was produced here at home using only American resources. But then we have to think about the American working in Germany, the American automotive engineer that I spoke of. So what do we do with his salary? That has to be added on, don't you think? So this is the US engineer in Germany. And this is the Japanese manager in the US. Am I making sense to you? This would give us GNP, wouldn't it? And now we have a term for these things. This money here, or sums like it, is called factor payments from abroad. Because this is money that American resources are earning abroad. So you think of this as factor payments from abroad. The 500,000, on the other hand, is considered to be factor payments to abroad. Now, this is money that is not, strictly speaking, may not be leaving the States. The Japanese manager lives here, doesn't he? He pays his mortgage here and does his shopping here. So you don't have to think of this money as actually physically leaving the States. That's not how you think of it. But you think of it as money earned by a foreign resource that is working here in the States. It's called factor payments going abroad or to abroad. Right? So we now have a relationship between GNP and GDP. And that relationship is that GNP is equal to GDP plus net factor income from abroad. And what is net factor income from abroad? It's factor payments from abroad. That would be the $150,000. So this here is the $150,000 earned by the American engineer in Germany. And the other bit is the $500,000 earned by the Japanese engineer Japanese manager here in the States. right? So this has to be then added to GDP to get GNP. Yes? So we now have the idea of GNP. So let me ask you a question that, that some of you may relate to. Consider a maquiladora, which is, a factory across the border in Mexico, owned by an American corporation, typically, right? So these are factories owned by American companies that operate in Mexico so as to take advantage of cheap Mexican labor, right? Let's say that this particular maquiladora produces $1 million worth of goods each year. Question to you, is this million part of the US's GDP? Is this million part of the US's GDP? No, because this is production that took place outside the borders of the states. Is it part of Mexican GDP? Yes, it is part of Mexican GDP, correct? Now the next question. Is this 1 million part of US GNP? Aha, GNP is what's produced using American resources. My question to you is, are all the resources in that maquiladora American resources? Now, didn't I mention that the reason the maquiladora located in Mexico is to take advantage of Mexican labor? So Mexican labor is involved in that process. And Mexican labor is Mexican resource. So this 1 million, does all of it belong to US GNP? Not all of it. You have to break up this million into two parts. That contributed to by Mexican resources and that contributed to by American resources. Now in that factory, what is the American resource and what is the Mexican resource? Well, the labor is clearly Mexican. The capital is American. The machinery is American. In the sense, the American corporation owns that machinery. The factory itself, in other words. Correct? So how do you break up the million into what's produced by the Mexican labor and what's contributed to by the machinery? Is it possible to even do this? Because the two things work together to produce whatever it is that they're producing. How do you break this up into these two parts? Any thoughts? That's exactly right. If you subtract what the Mexican workers are paid, if you subtract the payroll, in other words. Now, wouldn't you have subtracted the contribution of the Mexican workers under the assumption, of course, that all resources are paid the value of their contribution? Right? So if you take this 1 million and you subtract from it the wage bill, the peso wage bill, let's put it that way, right? We would have arrived at the contribution of the American machinery, and that part would be part of US GNP, right? And here we have a table. So we've talked about a few of these things, and we haven't talked about some others, but this makes it all clear, okay? So we have GDP, and then if you add this net factor income from abroad, which is basically the money earned, add the money earned by the American engineer in Germany, subtract the salary of the Japanese manager in the States. If you do that, you arrive at GNP. Yes? Then, from GNP, if you subtract depreciation, the gross becomes a net. So when you take any gross figure and you subtract from it depreciation, which is the wear and tear of machinery, you arrive at net. I have a minute or two. Let me just quickly finish this. So that gives you net national product. If you add statistical discrepancy to net national product, you arrive at what's called national income. Right? And then from national income, you add transfer payments and you subtract retained profits. Now, what are transfer payments? Transfer payments are incomes received by households for which they have not worked. Now, remember, I said that any worker is paid the value of his contribution. Is that correct? But what if you receive a Social Security check. How is that money to be treated? Let's say you receive $1,000 of Social Security payments every month. Is this part of GDP or, for instance, any of these other things? No, because nothing was produced. There is no production of a final good or service that lies behind that $1,000. On the other hand, if that $1,000 were a wage payment, then there is some production that lies behind it. Correct? So we need to add transfer payments. Actually, at this point, I am going to stop because I won't be able to finish this in class today. Okay? So we will carry on next class.